For most of modern American history, there was one belief so deeply accepted that almost nobody questioned it. If you worked hard, earned a decent income, and made responsible decisions, life would gradually become more stable over time. Not luxurious, not easy, just manageable. But across the United States right now, millions of people are discovering something deeply unsettling. They did everything they were told to do, and the math still stopped working. Every morning before sunrise, highways across America fill with people spending hundreds of dollars a week just to reach the place that pays them. And most of them do not fully realize how much it is actually costing them. Not just in gas, but in insurance, tolls, repairs, car payments, lost time, stress, exhaustion, and debt that quietly compounds in the background month after month. For a growing number of middle-class households, the cost of commuting is no longer a minor inconvenience. It is becoming a second housing payment hidden inside everyday life. And here's why this story matters far more than people think. The households being crushed by these costs are not reckless spenders. They are not people making obviously irresponsible decisions. In many cases, these are families who followed the American playbook almost perfectly. They bought homes they believed they could responsibly afford. They moved farther from cities to get more space, safer neighborhoods, better schools, and lower monthly payments. The decision made complete sense at the time. In fact, for years, it worked exactly the way it was supposed to, until one assumption underneath the entire system quietly broke. Because the modern American middle class was built around a dangerous idea nobody really noticed during the years of cheap money and low interest rates. That driving to work would remain affordable forever. And once that assumption failed, everything else started tightening at the same time. Fuel costs surged. Insurance premiums exploded. Vehicle prices jumped. Interest rates climbed. Remote work disappeared for millions of employees who had already moved hours away from their offices. Suddenly, families that once felt financially stable found themselves trapped between mortgages they cannot give up and commutes they cannot afford to keep. And the frightening part is that this pressure is still largely invisible in the economic data people look at every day. Because on the surface, America still appears normal. Airports are packed. Restaurants are busy. Concerts sell out in minutes. But beneath that surface, millions of households are quietly financing normal life with debt, draining savings just to maintain routines that used to feel sustainable. The economy still looks functional from the outside, but underneath, something far more fragile has been building for years. Tonight, we're going to break down how America accidentally created a commuter economy that many workers can no longer realistically afford, and why the consequences are starting to spread far beyond traffic, gas stations, or long drives to work. The problem did not begin with inflation, and it did not begin with gas prices either. To understand why so many households suddenly feel financially trapped, you have to go back to a period when everything actually seemed to be improving. For years, the financial logic behind suburban America looked almost unbeatable. In major cities across the country, housing prices were rising so aggressively that middle-income families started facing impossible trade-offs. Stay close to work and spend half your income on a small apartment. Or move farther away and finally get the kind of life that once defined the American middle class. More space, a backyard, quiet streets, better schools, maybe even enough room for children to grow up without sharing walls with strangers. For millions of families, the decision felt obvious. And economically, it was rational. In city after city, households discovered they could buy a 3-bedroom home in the outer suburbs for nearly the same monthly payment as a tiny apartment closer to downtown. The trade-off was distance. Maybe 45 minutes to work instead of 15. Maybe an hour if traffic was bad. But at the time, that felt manageable because the cost of driving still fit comfortably inside most household budgets. Gas was annoying sometimes, but survivable. Insurance was expensive, but predictable. Car payments were part of normal life. The system seemed stable enough that people built their entire futures around it. Then something happened that dramatically accelerated the trend. During the pandemic, remote work changed the equation completely. Suddenly, millions of Americans realized they did not need to live close to the office anymore. Workers who used to spend 5 days a week commuting discovered they only needed to go in twice. Sometimes not at all. And once that happened, the distance between home and work stopped feeling like a major financial risk. A commute that only happened a couple days a week felt almost irrelevant compared to the opportunity to finally own a home. This triggered one of the largest geographic reshufflings in modern American life. Families poured into outer suburbs, smaller cities, and exurban communities far beyond traditional commuting zones. Housing markets exploded in places that had never experienced that level of demand before. And again, the logic made perfect sense. Why keep paying premium city prices if your office had effectively moved into your laptop? But underneath all of this was a dangerous assumption that almost nobody questioned because the environment at the time rewarded it so heavily. People assumed the remote work era was permanent, or at least permanent enough to structure major life decisions around. Mortgage lenders assumed it. Buyers assumed it. Employers implied it. Entire financial plans were built on the belief that daily commuting had fundamentally changed forever. Then the reversal started. One company after another began calling workers back. First gradually, then aggressively. Large employers across finance, tech, government, consulting, and corporate America started issuing return-to-office mandates throughout 2023 and 2024. For some workers, hybrid schedules remained. But for millions of others, the old commute suddenly returned almost overnight. Except now the geography was completely different. The worker who used to drive 20 minutes each way was now driving 75. The employee who bought a home believing they would commute twice a week suddenly found themselves back on the highway 5 full days again. And the timing could not have been worse because the cost of operating a vehicle in America had already started rising across almost every category simultaneously. This is where the financial pressure stopped feeling temporary and started becoming structural. A commuter driving 70 to 90 miles round trip every day is not dealing with a small lifestyle inconvenience anymore. They are operating a transportation system that can quietly consume well over $1,000 a month once everything is included. Fuel alone can easily cross $400 to $500 monthly, depending on location and vehicle efficiency. Add insurance, which has surged nationwide in recent years. Add tolls. Add maintenance on a car accumulating tens of thousands of miles annually. Add depreciation on a vehicle losing value faster because it is being driven harder than originally planned. Then add the financing cost attached to that vehicle, often at interest rates dramatically higher than what buyers faced only a few years earlier. And this is where people outside the situation often misunderstand what is happening. They assume households should simply adjust, move closer, buy a cheaper car, downsize, cut expenses. But the reality is that many families already optimized their finances around the conditions that existed when those decisions were made. They were not irrational. The environment changed around them faster than they could realistically reposition. Selling the house often does not solve the problem because millions of homeowners locked in historically low mortgage rates during 2020 and 2021. Rates near 2 or 3% transformed monthly payments in ways that are almost impossible to replicate today. Giving up that mortgage to buy a smaller home closer to work could actually increase monthly housing costs by hundreds or even thousands of dollars because current interest rates are dramatically higher. So staying feels painful, but leaving feels worse. The same trap exists with vehicles. Car prices surged so aggressively after the pandemic that many households stretched loan terms beyond 6 years just to keep payments affordable. Today, large numbers of borrowers own more on their vehicles than those vehicles are actually worth. That limits their ability to trade in, refinance, or switch to something cheaper. The transportation system they depend on every day becomes financially locked in place at the exact moment costs are accelerating. And this is the hidden reality behind so much middle-class anxiety right now. People are not panicking because of one catastrophic event. They are slowly suffocating under multiple, manageable expenses rising together at the same time. No single bill looks devastating on paper, but combined, they quietly erase the financial margin that used to protect households from falling behind. That margin matters more than most people realize, because once it disappears, every unexpected expense becomes dangerous. A blown transmission, a medical bill, a reduction in work hours, a surprise insurance increase. Problems that once felt stressful but survivable suddenly become destabilizing. And this is exactly why so many households with decent incomes still report feeling financially insecure despite low unemployment numbers and rising wages on paper. The paycheck may have increased, but the cost of maintaining normal life increased faster. And nowhere is that reality more visible than inside the modern American commute. What makes this situation especially dangerous is how invisible it looks from the outside. Most financial stress does not arrive dramatically. It builds quietly, in routines, so normal people stop noticing the damage they are doing to themselves. A person wakes up at 5:30 in the morning because traffic has become unpredictable. They leave the house before sunrise, sit on highways for an hour and a half, work a full day mentally exhausted before lunch even begins, then repeat the same drive home surrounded by thousands of other people doing the exact same thing. By the time they walk through the front door, it is almost evening. And at that point, the real cost of commuting starts showing up in places economists rarely measure properly. Because the commute does not just take money. It takes capacity. The energy to cook disappears first. After a 3-hour daily commute, convenience starts winning. More takeout, more fast food, more delivery apps. Not because people are irresponsible, but because exhaustion changes decision-making. Researchers studying chronic stress and long commute times have consistently found that mental fatigue reduces a person's ability to make long-term optimized decisions late in the day. In simple terms, people under constant time pressure start prioritizing immediate relief over future efficiency. And that behavior slowly becomes expensive. Then health starts slipping. Exercise becomes harder to maintain consistently when free time collapses. Sleep quality deteriorates because people either wake up earlier to beat traffic or stay up later trying to reclaim personal time they lost during the day. In simple terms, people under constant time pressure start prioritizing immediate relief over future efficiency. And that behavior slowly becomes expensive. Then health starts slipping. Exercise becomes harder to maintain consistently when free time collapses. Sleep quality deteriorates because people either wake up earlier to beat traffic or stay up later trying to reclaim personal time they lost during the day. Over months and years, that combination creates something researchers increasingly associate with long-distance commuting: elevated stress levels, higher rates of anxiety, increased cardiovascular risk, and worsening overall life satisfaction. But even those effects still do not fully capture the deeper problem. Long commutes quietly reduce ambition. Not instantly, not dramatically, gradually. A worker arriving home mentally drained every evening is less likely to pursue additional certifications, less likely to network, less likely to build a side business, less likely to negotiate aggressively for a promotion, less likely to take calculated risks that improve long-term income. The commute slowly consumes the very energy required to escape the financial pressure the commute itself is creating. And this is where the story stops being just about transportation and starts becoming something larger about modern economic life in America. For decades, economists largely evaluated commuting through measurable financial metrics: fuel costs, transit efficiency, traffic congestion, infrastructure spending. But millions of households are now experiencing a different kind of economic pressure that is much harder to chart on spreadsheets: lifestyle compression. That feeling where daily life slowly narrows. The vacation gets postponed. The gym membership quietly disappears. Friends are seen less often because weekends become recovery periods instead of social time. Hobbies shrink. Family dinners become rushed. Entire households begin operating around exhaustion management rather than actual enjoyment of life. And because this deterioration happens gradually, people adapt to it without fully realizing how much their quality of life has changed. That adaptation is one of the most psychologically important parts of this entire story. Human beings are remarkably good at normalizing pressure while it is happening, especially when everyone around them appears to be struggling too. A family that would have considered a $900 monthly commuting burden insane 5 years ago slowly absorbs it because there is no obvious alternative available. They adjust. They borrow a little. Cut back somewhere else. Delay savings. Use credit cards more frequently. They keep functioning. And from the outside, everything still appears normal. This is exactly why so many people become confused looking at the broader economy right now. Because the visible surface of consumer behavior still looks surprisingly strong. Airports remain crowded. Restaurants still have waiting lists. Concert tickets disappear instantly. Sporting events sell out. Travel demand remains elevated. If households are truly under this much pressure, people ask, Why does the economy still look active? The answer is uncomfortable because spending alone does not automatically mean financial health. The economy measures transactions. It does not measure the emotional condition underneath those transactions. A family using a credit card for a vacation still counts as consumer spending. A worker financing groceries through buy now pay later apps still counts as consumer activity. The data registers the purchase, not the financial strain behind it. And increasingly, many households are sustaining normal life by stretching debt much further than they used to. This is not speculation anymore. Credit card balances in the United States have climbed to record levels in recent years, while average interest rates on those balances surged past 20%. Auto loan delinquencies have also risen, particularly among financially vulnerable borrowers. Buy now pay later services, originally associated with electronics and discretionary shopping, expanded aggressively into essentials like groceries, utility payments, and everyday household spending. That shift matters because it reveals something deeper psychologically. When people feel financially squeezed for long enough, they often become more protective of experiences, not less. This sounds irrational at first, but behavioral economists have studied versions of this pattern repeatedly. Households under chronic financial stress frequently continue spending on occasional moments of relief because eliminating every enjoyable experience creates its own form of emotional burnout. A concert, a weekend trip, dinner out with family. These purchases can become psychological escapes from an increasingly compressed daily routine, which means packed restaurants and crowded airports do not necessarily prove households are financially comfortable. In many cases, they may actually reflect households trying to preserve some feeling of normal life, while broader financial stability quietly deteriorates underneath. And this creates one of the most dangerous illusions inside modern economic data. The weakening often stays hidden until suddenly it doesn't. Because financially stressed households can continue functioning for surprisingly long periods of time. They continue making payments, continue commuting, continue spending selectively, continue appearing stable from the outside. The deterioration underneath builds silently through rising balances, shrinking savings, deferred maintenance, and increasing emotional fatigue. Then eventually something breaks. Not because one catastrophic event happened, but because the system finally ran out of flexibility. And historically, that is exactly how many economic slowdowns begin. Not with panic first, with exhaustion first. By the time most economic problems become visible in official data, households have usually been struggling for much longer than anyone realizes. That delay is one of the reasons financial pressure can spread so widely before policymakers, businesses, or even families themselves fully understand what is happening. Because on paper, much of the American economy still looks relatively stable. Unemployment remains historically low compared to past recessions. Wage growth exists. Consumer spending continues. Corporate earnings in many sectors remain solid. If you only looked at headlines, you could easily conclude that households are adapting reasonably well to inflation and higher costs. But confidence tells a different story. For the past several years, consumer sentiment surveys in the United States have remained unusually weak even during periods where employment numbers appeared healthy. Normally, confidence and spending move somewhat together. When people feel financially secure, they spend comfortably. When they feel uncertain, spending slows. But recently, those two signals started separating in a way economists pay very close attention to because historically, it often points to underlying instability building beneath the surface. People may continue spending for a while, but emotionally, they no longer feel financially safe. And that distinction changes behavior long before it changes headlines. A worker filling up their gas tank today is not just reacting to the price on the screen. They are subconsciously calculating something much larger. How much of their paycheck disappears before life even begins? How much effort is required simply to maintain routines that once felt ordinary? How little margin remains if anything unexpected goes wrong? That psychological pressure accumulates. And once enough households start feeling it simultaneously, subtle behavioral changes begin spreading through the economy everywhere at once. People delay replacing appliances. They skip preventive medical care. They drive on worn tires longer than they should. They postpone home repairs. They resist price increases that they might have accepted easily 2 years earlier. Restaurants notice smaller tabs. Retailers notice longer hesitation before purchases. Families stop planning larger future expenses because the future itself feels harder to predict confidently. None of these changes individually look dramatic. Together, they become economically significant. This is the phase where financial strain transitions from a private household problem into a broader macroeconomic problem. And one of the clearest warning signs sits inside the American debt system right now. For almost a decade before inflation surged, extremely low interest rates made borrowing feel relatively painless for large parts of the population. Carrying some credit card debt was manageable. Financing vehicles was cheap. Monthly payments stayed low enough that households could absorb them without completely destabilizing their budgets. Then rates changed faster than most people had experienced in their adult lives. Beginning in 2022, the Federal Reserve aggressively raised interest rates to fight inflation. Mortgage rates surged. Auto financing costs climbed sharply. Most importantly for everyday households, credit card interest rates exploded because they are directly tied to broader benchmark rates. Today, average credit card APRs above 20% have become common across the United States. That number matters enormously because high-interest debt behaves differently psychologically than normal monthly expenses. Interest compounds invisibly. People feel the pressure without always fully grasping how aggressively balances are growing underneath. A household carrying $8,000 to $10,000 in revolving credit card debt can now spend well over $1,000 annually just on interest payments without meaningfully reducing the original balance. That money produces nothing. It